All right, let's dive into a real head scratcher from the market. Workday just dropped what looked like a fantastic earnings report. They beat estimates, even raised their outlook for the year. And what happened? The stock immediately dropped. So what gives? We're going to unpack the numbers and figure out what Wall Street was seeing that maybe the rest of us missed. So we've got this classic puzzle on our hands. On paper, everything Workday reported looked, well, perfect. A textbook earnings beat. But the market, as you know, had other ideas, and its reaction tells a totally different story. So let's start with the good news, the stuff that makes this whole situation so confusing in the first place. Okay, first things first, let's talk bottom line. Workday posted adjusted earnings of $2.21 per share. That's a full 9 cents above what the street was looking for. Now, in the world of big enterprise software, that's not just a little beat. Nope, that's a really solid signal that they're running the business efficiently. So, chalk one up for the bull case. Next up, the engine room of any software-as-a-service company. That sweet, sweet subscription revenue. I mean, this is the sticky, predictable income that investors absolutely love to see. And Workday grew it by a really healthy 14% to almost $2.2 billion. So you've got strong profits and strong top-line growth. The picture just keeps getting rosier, right? And then they did something that should have sealed the deal. Management was so confident, they actually raised their revenue forecast for the entire year. A guidance raise is one of the most bullish signals you can get. It's basically management grabbing the microphone and telling Wall Street, hey, things are going even better than we told you they would. So let's recap. Beat on earnings, beat on revenue, and they raised the outlook. The stock's got to be soaring, right? Wrong. It dropped, down almost 3% by the close. And get this, the trading volume was huge, nearly triple the normal daily average. This wasn't just a few people taking profits. This was the big fish, the institutions, hitting the sell button hard. Despite all those positive headlines, the big money was heading for the exits. And that brings us to the million-dollar question we're tackling here. With all this great news, what on earth spooked them? To get to the bottom of it, we've got to look at the two completely different stories that were being told right after this earnings call. Okay, so let's start with the bull case. This is the story Workday's management is telling. And in their version of events, the future is looking absolutely phenomenal. And it's all thanks to one big thing: artificial intelligence. I mean, the CEO, Carl Eschenbach, he was all in on AI during the call. He didn't just sprinkle it in, he put it right at the heart of everything. He basically said this whole solid quarter happened because of their AI strategy. And he claimed AI is now front and center in every single customer conversation. The message is loud and clear. Forget software company. They want you to think AI company. And look, this isn't just some marketing fluff. They've got the numbers to prove it. Over 3/4 of their brand new deals had AI baked in. That's huge. It means new clients are buying the vision from day one. And the payoff? Well, the annual contract value they're getting from AI products literally doubled in just 1 year. You can't argue with that kind of growth. They're also pulling out the checkbook. They aren't just trying to build all this AI from scratch. They're going shopping. They snapped up a company called Flowise to help clients build their own AI agents, and then they announced a really big one. They're buying Paradox, which is a huge name in AI recruiting tech. And this Paradox deal, it's a real game changer. This isn't about hiring another software engineer in an office. No, this is aimed squarely at the massive, high-volume world of frontline workers. Think retail, healthcare, that kind of thing. They're basically building this incredible AI-powered machine to handle recruiting, which saves recruiters a ton of time and gives companies a real, tangible return on their investment. It's a brilliant strategic play. Okay, so there you have it. That's the bull case. Firing on all cylinders, an AI powerhouse. Sounds pretty unstoppable, right? So, again, why the heck did the stock drop? Now we've got to flip the coin and look at the market side of the story, what the bears were seeing. And this is where you can really see the two worlds collide. On one hand, management is pointing to strong AI plus this thing called cRPO, which is basically their contract backlog, growing at over 16%. That's a great sign for future health. But what did the market zoom in on? The guidance for just the next 3 months. And it was just fine. It was in line. Not bad, but not amazing either. And that little detail was all it took to feed into this bigger fear that all of software is slowing down. You know, the CEO even tried to get ahead of another big fear investors have, the idea that AI might actually hurt their core business model, which is based on how many employees a customer has. He was super direct, basically saying any worries about that are completely overblown.
He's convinced they're going to be a winner, not a loser, in the AI revolution. And here's the kicker, the context that really matters. The market isn't just being paranoid for no reason. Look at this. Over the last year, the whole software sector is up almost 32%, and Workday? It's down over 4%. When you're lagging the pack that much, investors get really, really antsy about any sign of weakness. They have zero patience for an inline quarter. All right, so you've heard both sides, the super optimistic bull case from management and the super cautious bear case from the market. So where do we land on this? Let's get into our call on the stock. So for the third quarter, our prediction is pretty straightforward. We think they're going to hit their numbers, right in line with what they told everyone. No big surprises. And because of that, we see the stock just kind of treading water, probably stuck in a trading range between $210 and $230 while everyone waits for the next big piece of news to break the tie. So that brings us to our final rating, market perform. Look, the long-term AI story is fantastic. It's really compelling. But right now, it's being canceled out by these short-term worries about the pace of growth. The stock just feels fairly valued, stuck in the middle until one side can definitively prove it's right.
So what could break the stalemate? What should you be watching for? Let's wrap up with the key events coming up that could send this stock moving one way or the other. Okay, mark your calendars. There are 3 big things to watch. First up, September 16th. That's their big analyst day. That's show and tell time for their AI roadmap. They need to wow people. Next, we'll see the Paradox acquisition finalize sometime in the quarter. How smoothly that integration goes will be a big tell. And finally, of course, the next earnings report in late November. All eyes are going to be on one thing, guidance for the end of the year. They need to show some real acceleration. So in the end, the whole debate about Workday really boils down to this. Are you a show-me-now investor, focused on today's solid but unspectacular numbers? Or are you a tell-me-a-story investor, betting on that massive AI future they're promising? The next few months are going to tell us which narrative wins. And as always, please remember, this is not financial advice.